We've got through the first few weeks of investing now, and payments haven't quite been almost daily just yet. So it's not exactly in the full flow state just yet, but the payments are coming in. As we'll see in a bit, the portfolio has recovered pretty well after all this Iran business too, so things are looking decent so far. Now let's get into it, but first, hello and welcome to Almost Daily Dividends. This is the channel that will be all about tracking the progress of the pie and answering your investing questions along the way. The content that will be discussed is intended for information and educational purposes only, and should not be considered investment advice or investment recommendations. When investing, your capital is at risk and you may get back less than invested. Past performance does not guarantee future results. We'll start off with portfolio performance. Still down, but nowhere near as bad as a couple weeks ago, and that's part of the beauty of dollar cost averaging, I guess, as you take the good with the bad and you just keep buying. Now, as the stocks in this pie have started their recovery, those buys at the lower points mean that the gain is just a little better. Top stock this week is a bit of a surprising one, all things considered, with how well CF Industries and Chevron have done, and it's Citigroup up 8.55%. Biggest loser this week is also a different one to last week, and it's Cisco down 11.97% in total. This is the total return, by the way, not the weekly drop necessarily, in case that's what you were thinking. I'm not sure if there's an easy way to see which stock performed best or worst in that specific week, but if you do know a way to see that on Trading 212, do let me know as I can show it in the video. Dividend payouts. Big jump in payments this week and we are up to 69 pence. Pretty amusing total number to have at the end of the week, but it's pure coincidence, I can assure you. Hoping that we also get a nice £4.20 in a few months too. I don't know if you guys want the full breakdown of dividends in this section, or anything else from the Trading 212 portfolio that you want to see. Do let me know in the comments if there's something else you want to see in this part. While we're on the topic of Trading 212, I asked Trading 212 if they could give me a unique code that you guys can simply type into the promo code section. When investing, your capital at risk. Sponsor code, terms apply. So if you've opened a new account recently or are planning to open an account soon, then here it is, DivExP or DIVEXP, short for the Dividend Experiment. You have 10 days from opening your account to type this in and receive free fractional shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. Now let's move on to the more advanced analysis of the pie so far. Further analysis. For this part of the weekly video, we'll look to Simply Wall Street to do a bit of a deeper dive. The overall portfolio snowflake is looking good, skewing more towards health, value and dividend compared to future, but that's really what you'd expect from a dividend portfolio. I can't imagine this changes much week to week, or at least it hasn't since we started. Future dividends. Each week I plan to check in on the dividend projection provided by Simply Wall Street to see how it's increasing over time as we deposit more into it. Or hopefully increasing over time anyway. Last week it provided us with a reading of a projected £33.05 in dividends, so a yield of around 3.1%, which is pretty much in line with the data on the dividend dashboard. This is basically saying that with the amount invested now, and without adding, the payments over the course of the next year from today would be estimated to equal £33.05. This week, after the increase in total amount deposited, our future income projections have grown too. It's now at a £36.27 projected payout across a year, or an average monthly of £3.02. We've broken the £3 per month average milestone with the recent deposit, if you can even call that a milestone, realistically. When it comes to monthly, it's important to remember that the number shown is a payment on average, so some months will be higher than others, rather than it being a set, defined amount you get every month. The future dividend projection is super useful information to know, as people often get wild expectations in terms of how much dividends they'll get early on in their dividend investing career. Either they dismiss it completely, as they can't imagine the exponential compounding growth over time as we add more, and it reinvests on itself, or they way overestimate how much they'll be getting. Any news updates? Let's take a look at some news stories happening on some of the stocks. As we saw earlier with Cisco being the lowest performer in the pie, investor sentiment has deteriorated. The Simply Wall Street discounted cash flow analysis suggests Cisco is now undervalued by 52.4%, however. Whenever there's a difference in opinion, there are going to be winners and losers. Let's see if it develops into anything concerning over time. Some news for Abbott Laboratories, with revenue forecasts increasing but earnings per share estimates falling by 11%. And then a narrative update for IBM. Analysts have trimmed their average price targets on IBM by a wide range. They're weighing slower mainframe and consulting trends against broader hybrid cloud and AI opportunities, as well as a slightly lower assumed discount rate and PE multiple in current models. Now in the videos, I'll pick just a few of the more interesting updates since the last video. As there are 50 stocks, there'll be many. If you want to read more details on any of these, welcome to use the link straight to the portfolio in the description. The link to the portfolio means you can use it at any time to see how the portfolio or any of the stocks in it are doing. You should be able to use it to see the details talked about in the videos without even having to sign up. You can also get a free trial and 30% off all Simply Wall Street subscription plans if you wanted to have it personalised to your own portfolio, using that same link in the description and pinned comment. On top of that, if you do decide to sign up, it's a referral link, so that helps support the channel too. Q&A. Let's move on to the Q&A, where I take your questions from the comment section and do my best to answer them. Let's get into it. Okay, first question, and it's a classic. Is now a good time to be investing in this pie? It reminds me of the famous quote, "The best time to plant a tree was 20 years ago, but the next best time is now." Generally speaking, the longer time you have to invest, the more time that your investment has to compound, and the better your investment will do. This is, generally speaking, if you have a diverse portfolio like an index fund, or to a slightly lesser degree, this pie. I also made this video about the cost of waiting for a good time to invest, and the fact that it essentially will never be a good time, and there's literally been an exciting and compelling reason why it's a bad time to invest every single year for decades. And back to this pie specifically, there are 50 components, and it's a decent split across different sectors and industries, as you can see from the pie chart, and this is found on the Dividend dashboard, by the way. Trying to time such an investment to your advantage is, in my opinion, not realistic. We've even seen so far with this series that even a catastrophic geopolitical event like war can be beneficial for some stocks and detrimental to others, so it's just not going to be likely that you'll be able to get the right time that works for you. A better way to think of it is to see if the pie suits your investment strategy and invest according to that strategy. I don't think it's a good use of time and resources to try to tactically buy and sell a strategic investment. Next question, and about the series itself rather than the pie. The plan for this series is to do it for 6 months. It was, and still is I guess, a bit of a gamble whether or not it would take off and people would find it interesting enough to sustain it as a series. So we'll try it for 6 months with weekly videos, see how popular it is by the end, and then do it for another 6 months if it works out. And on a similar topic, here's another question that I can answer at the same time. Well, it's more like an accusation really, the way it's been written. So for context, in order to make these videos and series as a whole, I needed to set up a separate account to track the API, set up a new YouTube channel and get the template for the YouTube series in a way that's compliant with UK regulation, i.e. not giving or saying anything that could be construed as personalised financial advice to viewers. That's harder with a dedicated Q&A section, obviously. Then each week I need to write the script, get the images from the software, write the script, then record and edit the audio. The animation then needs to be edited and rendered, etc, etc. Now this whiny commenter seems to think that I'm telling you this to make out that I'm hard done by or that I deserve some pity for doing it, and that's not really my point at all. The point is that there's something called opportunity cost. As there's only a limited number of hours in the day or week, I'm using them up to create this, but I could be making something on the main channel that you guys prefer. That's the main point. It's not like this is a free extra series to add on, it's replacing something else that could exist if the resources were put into that. Now I think this series is interesting and fun, as well as a great way to demonstrate the realities of investing in the pie, and the reception so far has been very positive, so there's not really a danger of it ending anytime soon. The question is about whether to keep cash outside of the pie as the interest rate is decent. Yes, that can absolutely make sense depending on your situation. If you have a lower risk tolerance or want to keep an emergency fund easily accessible, leaving some cash outside the pie to earn a 3.8% AER is a really sensible move. An emergency fund sitting in a pie is still exposed to market volatility, so if the market dips right when you need the money, you could end up selling at a loss. Keeping the cash separate means it's stable, accessible, and still earning a decent return in the meantime. For money that you might need at short notice, a guaranteed 3.8% beats the stress of watching it fluctuate. The general rule of thumb is to have 3 to 6 months of expenses set aside before going all in on investing. Building it up in the cash account first is a perfectly valid approach. I go over this topic of keeping cash in high interest accounts versus dividend investing here on this video from a little while ago now. Actually, this was when Trading 212 interest rates and the Bank of England rates in general were a little higher than it is now even. Okay, next question. What is share lending and how does it work, or is it worth doing? Good question here on share lending. To explain what it is, share lending is where your broker, in this case Trading 212, lends out your shares to other parties, typically for short sellers or institutional investors. And in return, you earn a small amount of interest on top of your normal returns. You still own the shares throughout the process and can sell them at any time, so it doesn't affect your investing strategy at all. That said, it's not entirely without drawbacks. The main one is that while your shares are on loan, any dividends you receive are replaced by manufactured payments, which are taxed differently to normal dividends in some jurisdictions, so depending on your tax situation, this could be a slight downside. There's also a small counterparty risk, meaning that if the borrower defaults, you're relying on Trading 212's collateral protection for those lent shares. It's also worth noting that share lending isn't available on the Stocks and Shares ISA, so it's only an option if you're investing through a general investment account. However, personally I think the pros greatly outweigh the cons for most long-term investors. It's essentially extra passive income on shares you're already holding and not planning to sell anytime soon. The risks are relatively low in practice, and the tax situation only really matters if you're receiving significant dividends. If you're a buy and hold investor with general account, it's well worth considering. Though I would say don't go out looking for high interest shares to lend out specifically, but instead just lend out the shares that you want to own anyway. When the feature first came out, I made this video which covers it in more detail, but it's a little old now. Okay, next question. I like this question, it's a bit of a thought experiment. Is there a point when you should sell a stock despite it fitting the target profile of a dividend company? Let's say one of the companies in the pie drops 10% a week consistently for a long period. You could dollar cost average down to reduce losses, but it's unlikely that you'd realise a gain from that stock even over a long time, and that money would be better spent elsewhere. Is there a strategy that can be deployed here to cut losses and maximise gains over time? It's an interesting hypothetical, but let's play it out. So we have a dividend stock that fits the target profile of a dividend paying stock, and let's say it's $100 and pays a dividend of $5. The yield is 5%. It falls 10% now, so it's down to $90, but as yield has an inverse relationship with price, that means that the yield has risen to about 5.6%. We've lost $10, but the yield of the stock to buy now has increased. Now let's say it falls another 10% and it's at $81, but again yield has risen and now it's at 6.2%. In this hypothetical, the company has not changed, it fits the target profile of a dividend payer, but the yield for future investments has increased. If it follows this pattern, the price goes down, but the yield approaches infinity. Either something very weird is happening, or eventually the yield will be so strong that investors will come in to buy, which will then increase the price. It's not possible in the laws of economics or nature, I guess, where it would be the case that the stock would fall to that point without arbitrageurs coming in to take advantage of the yield and bringing the price back up. So if a stock has fallen that much without buyers coming in, then it's likely that something has changed with the company itself. And there are 3 criteria where a company gets removed from this pie. Minor updates are usually because of one of the following 3 reasons: a dividend cut, a high likelihood of a cut, a shareholder action affecting the holding. The one most related to the question here is where there's a high likelihood of a cut. And regarding the strategy that can be deployed, I came up with the will they cut framework for exactly this. This framework has 3 pillars that allow you to work out the clues that often lead companies to trim their payouts to shareholders. It goes through 3 pillars to assess how safe the dividend is: financial strength of the company, management signals, and external pressure. I added this as a framework module on the Dividend Academy, so there's a video section as well as a practical spreadsheet if you wanted to try it out for yourself. I'll link that in the pinned comment if I remember to do that. So to answer the question, if the stock of a company is falling with all else being equal, and you do have to make sure there's not some reason it's falling that you're simply not aware of, then it's a good thing if you're continuing to buy into the company long term. Future buys are lower, so you average down your cost, whilst the yield is getting higher with each buy. However, that scenario is very unrealistic, so it's instead better to use these 3 factors or a strategy you come up with yourself to assess how sustainable dividends are and if a cut is imminent. For the next question, it's just a follow up on this one from last week, asking about the Simply Wall Street discount, and I got a response on that question for this week. The referral discount only works from the link in the description, or a general referral link you might find out in the wild. However, they suggested asking customer service explaining the situation, that you're a free user but you want to upgrade after seeing a video with discount, and there's a decent chance it might work out for you. In addition, if you do the free trial, you do only have 14 days after signing up to get your 30% off too. And until the 13th of April, the discount increases to 40%, thanks to the Simply Wall Street Easter promo. Okay, next question is about the Metronome portfolio. I won't go into too much detail here on the Metronome portfolio itself, as I have a whole video on that on the main channel with a thumbnail that looks like this. But in short, the base of the Metronome, the dividend and income part of the portfolio, would be where a pie like this would fit. Maybe you'd want to combine it with other investments to make up the base, but that's the general segment where it would go. In terms of using the ISA or ISA, for most people the stocks and shares ISA tends to be the go-to starting point, simply because any gains and dividends are completely tax-free from a UK tax perspective, which can make a big difference over the long run. The general investor account can make more sense in certain situations. For example, you've already used up your ISA allowance for the year, or you want access to share lending. It is, however, worth doing a bit of research into both and considering your own tax situation before deciding. Okay, a detailed question here. My initial thoughts was to direct this one to a video on the channel, but then I realised that even though it's the ethos of the channel as a whole, there isn't really a direct video to link this to. I'm not going to be able to go into great detail on this question here as it's complex and needs a lot of nuance to answer properly. So sorry I can't answer here, but I will make a dedicated video on this on the main channel to cover this in more detail. As a reminder, if you want your question to be answered, then you'd have to comment on the YouTube video of the most recent episode. So as you're watching this right now, if it's the most recent one available, then comment your questions below and I'll answer in the video for next week. It can get super difficult to find and keep up with the questions and comments on recent videos. Basically, if you comment on the most recent video and it needs an answer longer than a simple comment reply, I'll try to answer it in the upcoming video. I will say if there are somehow hundreds of questions, then I might only pick a few of them, but I will try my best. There are some rules for questions I set out in the very first intro, nothing too strict. I just want to avoid the time-wasting type questions or any questions that are specifically requesting personalised financial advice, which I'm unable to give. Other than that, pie or general investing questions are pretty much fair game, even if they're only tangentially related to the series. You're also welcome to give non-question type feedback on the series too, if there's some aspect of it that you want to see or more details on another part. The idea is for new investors to get a good idea of how the almost daily dividend pie, and by extension investing in general, works, but trying to make it as interesting and fun as possible along the way. See you on the next weekly episode. Hey, thanks for watching this recent episode in the Almost Daily Dividends tracking series all the way through. Just a couple of things before you go. First is, as this is a freshly set up channel, if you want to stay up to date with the new episodes, the best thing to do is to subscribe and turn on the notifications. If you're a Pi copier and want to get all the details of when I make changes to the Pi and the reasons for the changes, then the best place to do that is sign up to the mailing list. I'll also give you a PDF guide to my 10 dividend investing commandments, or the rules that I use to help choose dividend paying companies to buy. Finally, if you want to find out more details about the Pi, then check out the links in the description for more info. See you in the next one.